cognate experiences and extensive career spanning over 30 years. Mr. Johnson is a trained facilitator over the years in the Institute of Chartered Accountants, FITC, and is actively involved in training of Nigerian banking professionals. He's a regular media commentator on the Nigerian capital market and banking industry, both domestically and internationally, across all channels. So I would like to welcome you, sir, to to the second session of our webinar series, for you to give us the review of the first half of the year and then the outlook of the financial markets. You're welcome on board, sir.
Thank you, everyone. Thank you, Hans.
Okay, that I'll do that right here.
Good afternoon, everyone. Good afternoon, my colleagues. Good afternoon, customers. Good afternoon, Nigerians. It's always a pleasure to have this session and like we program. So I will be speaking on. Hamza has done the basic introduction, so I will just go straight to the on the first half of 2021 and the outlook for the second half of 2022. Sorry, first half of 2022 and the economic outlook for the second half of 2022. In summary, we've seen we are all living witnesses to the turmoil that was caused on the global economy by the geopolitical tension in Ukraine. We know Russia invaded Ukraine on the 24th of February 2022, and that has completely changed all the permutations, all the projections, and all the forecasts about the global economy, not just Nigerian economy. Of course, Nigeria was not excluded from the global economy. The inflation actually led to a major supply chain bottleneck, which led to elevated prices for energy and commodity prices, commodities. We've seen a sharp increase in the price of energy materials or energy sources, such as crude oil, refined petroleum products, even liquefied natural gas, and other energy sources. At the domestic level, we've seen low crude oil production, persistent decline in capital importation, accelerating inflation. Of course, we know inflation at the month of May came to a rate of 17.71%. We are seeing a worsening of the national debt profile. We are now dealing with a national debt of $100 billion. Local foreign currency debt of about $40 billion, when our foreign reserve is just about $39.1 billion. I mean, gross national reserve. So we have gradually gone back to a situation where our national debt is higher than our gross reserve. We've also seen rising insecurity. This morning, it was reported that the president's advance team going to his home state of Katsina was attacked and two policemen were killed, including our Assistant Commissioner of Police. I mean, that's the height of our effrontery by the bandits to attack a convoy of the president. Of course, the president could have been part of that convoy. That's to show you how bad the situation is getting. I mean, yesterday I read in the papers that about 48 people were killed in Shiroro last week. Of which about 34 of them were military men by Boko Haram or whatever you call them. So this is just a tip of the iceberg of what's going on in the country. And all these things have combined to exacerbate Nigeria's economic challenges. Then with the onset of political activity ahead of next year's general election, institutional portfolio and foreign portfolio investors, foreign direct investors are likely going to stay on the sidelines until the outcome of the election is known. My permutation or our projection is that once the election is announced and investors feel that the candidate who won the election is one they can hazard a guess on his or her. Of course, I don't think there's a female presidential candidate on his political or economic orientation. They are likely to go to decide on what direction to bet on Nigeria's assets. So I'm not going to talk about this. Hamza had already introduced me. Then, so far, 2022 so far, the global economic trend. Like I had mentioned earlier, geopolitical uncertainty occasioned by the Ukraine-Russian war, Russia-Ukraine war, as we used to call it, has led to a stunting of production and trade activities. We've seen economic growth stall as a result of the invasion occasioned by increase in energy sources. And I always say that nothing actually works in the world, that energy is a fuel that gets everything working, either animate or inanimate objects. So when there's energy constraint, you will realize that the economy goes into a major slowdown. I'm sure some of you have listened to news last night where the South Africans are reporting about 9 hours of blackout in South Africa. I remember one of the experiences I had in South Africa, and I got there very in the morning in Sandton, and I begged them to give me a room because we arrived late, very early, and they were telling me that it's not yet time. So we're gisting. I said, look, in Nigeria, they could have considered the fact that I'm a diamond member of Hilton. And they were laughing. This is not Nigeria. I said, if you think this is Nigeria, this can be Nigeria. There and then they took light, and they couldn't believe it. But anyway, that had become a norm in South Africa. If you also listen to Sri Lanka's closed down schools because of energy supply sources. We are seeing Germany and other countries worried about energy supply sources, largely driven by the fact that, look, price of energy sources have gone up drastically. In Europe, there is a multiplicity of problems related to gas supply from Russia, as well as crude supply, which many of them had voluntarily decided to not to import. Then oil price, of course, that has led to an oil price hike. We've seen oil price rise on the back of the Russian invasion, peaking at $123 per barrel on 6th of June. But beyond that, we are still looking at oil price above $111, $112 per barrel. Average price in the first half of last year was about $58 per barrel. So we've seen about 140% increase in the price of average price of crude in the past year on year compared to the first half of last year. Of course, this was partly occasioned by the fact that Western government decided as part of their sanctions against Russia to wean themselves of Russian crude oil import. Russia also retaliated by insisting that Western economies have to pay for gas supply in rubles, and that has constrained gas supply and other energy supply sources globally. Of course, we know Russia is the third largest crude oil producer in the world and the second largest crude oil exporter in the world. So that will show you how strategic Russia is. In terms of gas supply, Russia alone is the largest exporter of gas in the world. And that's why any sanction on them, or war between them and Europe, has led to this kind of catastrophic impact. We've seen, as a result of increase in crude oil prices, increase in other energy sources, increase in food items, we've seen an uptick in inflation globally. As it stands today, Russia seems to be the only one whose inflation has begun to moderate. If you look at it, Turkey is leading the pack. Turkey's inflation rate got to 78.6%. In the month of May, 78.6%, but that's 79% inflation rate that Turkey is dealing with. Germany has 7.9%. These rates are in some countries about 40-year high. UK at 9.1% in May, the Eurozone at 8.1%, US at 8.6%, and Russia at 17.1%. Like I said, Russia is even moderated. But Nigeria's inflation came at a print of 17.71%. I attended a morning a business where the presenter said, look, if you adjust Nigeria's inflation to current basket of household consumption, because this current basket was, the basket they're using now was constructed in 2009, if you readjust it to current basket, that you are going to see inflation rate about 45%. And I tend to agree that current basket of consumer price index no longer represent, the 13 consumer items or consumer categories no longer fully represent the consumption pattern of average households. And that's why Nigerians seem to feel the impact of inflation more than the figures being published by the Bureau of Statistics. Of course, growth rates globally are likely going to suffer, and even the kind of reactions by central banks worldwide will actually worsen. this growth rate because they seem to be fighting inflation using the wrong tools. China is likely going to be most affected in terms of slowdown in its growth rate. Of course, we've seen China lock down. Their zero tolerance for COVID has also meant that they have not achieved herd immunity or community immunity, which other countries have achieved. And therefore, we are still seeing lockdown in China, which is affecting supply chain across the world. Just to emphasize the impact of the war, the Ukraine-Russian war on global supply chain across the world. If you look at this slide, I guess we cannot see my slide. I need somebody to just say yes so that I'm not speaking to the deaf. Can somebody just indicate that we're seeing?
We can see it. We can see it, sir.
Okay, good. Okay, if you look at this slide, you observe that between Russia and Ukraine, they account for 30% of global wheat exports. 30% of global wheat exports. They account for 20% of global maize exports and account for 73% of global sunflower exports and about 12% of global crude oil exports. I had also mentioned that Russia alone is the largest exporter of natural gas globally. So with the war going on, the Black Sea has been blockaded by Russia, which meant, also I need to also have mentioned that corn alone, Ukraine alone accounts for more than 30% of corn export in the world. So with the blockade of the Black Sea, that has constrained a lot of exports coming from Ukraine to the extent that the president of African Union, Sademal of Senegal, had to go to Russia to beg the Russian president to open a channel for the export of wheat and sunflower and maize to Africa. This had led to a major uptick in food inflation around the world and the energy supplies constraint we have already discussed. Ukraine and Russia are basically, in fact, what the Europeans say that Ukraine is the food basket of Europe. Ukraine and Russia are among the world's richest fertile agricultural land. They are, in fact, important bread basket as they account for over 30% of the world wheat export combined. Just to re-emphasize on the supply shock resulting from the Ukraine war, Belarus, Russia, and Ukraine are some of the world's largest fertilizer producers. Among the implications of the war is the disruption in fertilizer export to Africa and countries like Brazil and other Latin American food producing hubs, with consequent implications in food supply. The concerns now are that this is the planting season in most regions, the summer period, and that with the disruption even in fertilizer supply, that countries are not getting enough fertilizer to ensure that the level of productivity of their farm produce or their land, cultivated land, will be at the same level. So you're going to see possibly a further decline in yield of food products. Of course, in Nigeria's case, I even read an article that said, or a news item that said that Nigerian farmers are now resorting to manure because of the high cost of fertilizer. Of course, you can imagine how effective manure would be if the land, cultivated land, is huge. North Africa seems to be, of the African region, the most affected because North Africans, one of their major staples is wheat derived food items like bread and what have you. So North Africa is actually seem to be have a worst case, and this is leading to some level of social unrest. I'm sure you would have read the stories about demonstrations in Ghana, of heightened level of cost of living, and this is the concern that in poor countries that this could lead to social upheaval as a result of constraints, increase in energy sources and energy supply sources, and increase in the cost of basic food items. What's the impact of this on inflation? We've seen, I had mentioned this earlier, we've seen a major uptick in inflation to US inflation rate has moved to 8.6%, one of the highest in the past 40 years. We've also seen the UK inflation at 9.1%. Turkey, I had mentioned, had gone to 78.6%, and the Eurozone at about 8.1%. What's hit in Eurozone is Estonia, that has an inflation rate of 20% in the month of May, an increase of more than 1.2 basis points. I mean, 120 basis points compared to the figure of 18.8% it had in the month of in the month of April. Of course, the central banks have reacted, and some of them are reacting aggressively. So we've seen a shift in central bank monetary policies away from accommodative to restrictive or hawkish monetary policies. Most central banks around the world are increasing rates. We've seen 40 economies hike interest rate, hike their benchmark rate as part of efforts to fight inflation. The US Federal Reserve Bank, for instance, increased rate by 75 basis points, that is 0.75% in June, the most aggressive since 1994, following an earlier 25 basis point increase in the month of March. And this is expected that the US Federal Reserve Bank would increase rates 4 more times before the end of this year. The Swiss National Bank has also increased rates by 50 basis points from a minus 0.75% to a minus of 0.25%. So their interest is actually in negative territory. Bank of England increased rate by 25 basis points. The European Central Bank is said to increase rate by 25 basis points this month. The Bank of England has increased rate by 50 basis points from 1% to 1.5%. And Central Bank of Russia, interestingly, in the month of April, had increased rate to 20% to forestall exit of foreign portfolio investors. And when the sanctions began to roll in, but it has retaliated. And this is actually something that Nigerian economic managers should look at. Because if your economy is a productive economy, the likelihood that you will suffer from sanctions is minimal. And Russia seems to be riding the tide comfortably to the extent that Russia in the first 5 months of this year has earned $110 billion from export of crude oil, about 3 times what it earned for the same period for the entire of 2021. So in as much as the Western countries are cutting down on crude oil import from Russia, the likes of China and India are still importing from Russia. And because of the elevated price of crude, Russia has benefited immensely from a war it triggered. And Russia's concern is now that with the rate at which its currency is appreciating, its currency has appreciated by about 86% in the past 6 months, that the rate at which its currency is appreciating, it could get to a point where the exports will become very expensive. And therefore, it's actually reducing interest rate from a 20% high. It has dropped interest rate to 9.5%, the level it was before its invasion of Ukraine. There are concerns of default that by particularly fragile economies, as one, their export earnings decline as global economies are cooling down because of this high rate of inflation. As again, we know that when the US economy begins to increase rates, we have flight to safety. Portfolio investors leave frontier markets and move their investment back to more stable economies. Again, for countries that are not oil producing countries, their import bills have actually skyrocketed in the past 5 months, while as their export earnings have not improved. So many of them are going through major balance of payment difficulties. And that has put a challenge or created a challenge for them to meet their debt obligations. A country like Sri Lanka and Lebanon and Venezuela, as well as Zambia, have actually announced debt moratorium on their interest payments, which is considered as a default in Eurobond payment. Earlier this month, earlier in June, Russia defaulted, not because they needed to default, because they have the war chest to meet the obligation, but because the Western economies had imposed severe financial sanctions on Russia and frozen their foreign reserve. So Russia is not able to access the 630 billion it has in foreign reserve to meet interest payment to debt Russian bondholders. So that, for me, is quite understandable, because even those who are holding those instruments will persevere, hoping that when the war ends, Russia will pay arrears, because it had a way with her. Like I mentioned earlier, the country has earned over 110 billion in the first 5 months of this year. There are about 25 countries whose the yield on their Eurobond instruments are trading above 10%. These bonds are considered relatively junk or weak, and therefore these economies, investors are pricing the risk of default into their bond yield, and that's why their bonds are trading above 10%. And for those countries, there are concerns that if the current economic situation persists, they may find it difficult to meet their obligations to debt holders. Such countries include Ghana. I'm sure you would have heard the Ghanaian president instruct the Minister of Finance of Ghana and the Central Bank of Ghana to approach the IMF for support or for a programmed line. Remember earlier that the president of Ghana said they are not going to, excuse me, approach IMF, that they will rough it out. But as it stands today, given the burden of importing refined petroleum products, Ghana had to walk with his tail behind his legs and go back to IMF for support. Angola is one of those countries with bond yields, Eurobond yields above 10%. Argentina, El Salvador, Pakistan, Kenya, and unfortunately Nigeria is in this unpleasant and unwelcome group. Well, let's talk about our domestic economy. Our GDP grew by 3.11% in the first quarter of this year. This was a decline from the 3.98% recorded in the last quarter of this last year. Of course, we've seen a consistent decline in GDP since it plateaued at 5.01%. Sorry, that figure is 5.01% for the second quarter of last year. It dropped to 4.03%. And then 3.98% in the last quarter of last year, and then ended the first quarter of this year at 3.11%. This is not a pleasant trend that the Nigerian government must have to watch. And this why some of us are concerned that if we get a policy mix wrong, we could actually weaken that sector, which is the non-oil sector that is driving economic growth in the country. Of course, we know the oil sector has been a major laggard. The oil sector actually contracted at 26.04% in the first quarter of this year. That, to me, shows re-emphasizing what I had mentioned earlier, particularly when you talk of crude oil production. And then its contribution to the GDP has kept shrinking. But interestingly, the non-oil sector took the lap, and they grew by 6.08% year on year in the first quarter of this year. An improvement over the 5.28% and the 1.34% they recorded in Q1 2021 and Q4 2022. Q4 2021. Currently, the oil and non-oil sector accounts for about 93.37% of the GDP, which means the oil sector accounts for just 6.6% of our GDP as it stands today. And I always need to emphasize this when I'm talking to a large audience, that the problem we have in Nigeria is not because our economy is not broadly diversified. Our economy is largely diversified in terms of productivity. The problem is that the concentration of the economy as it relates to foreign exchange earning is still oil and gas sector. And whatever happens to oil and gas sector have a direct impact on our level of FX assets. We know that the country has gone through 2 recessions in the past 5 years, or in the past 7 years, 2016 and 2020. In both periods, there was a remarkable decline in crude oil price or crude oil production. In 2016, there was decline in crude oil price and decline in crude oil production. In 2020, there was a massive decline in crude oil prices across the world. And those factors contributed to pushing Nigeria into a recession. We are witnessing a consistent decline in crude oil production. According to IMF, OPEC, Nigeria's crude oil production in the month of May was only 1.024 million barrels a day. And they are concerned that if the current monetary policies being adopted goes into an or goes overboard, you could actually see a drastic reduction in crude prices. And if you have a reduction in crude prices at the time when our crude production is just about 1 million barrels, the economy could tip in the wrong direction. We saw a decline in crude prices because of the past 2 days, because of concerns that these policies being adopted by the central banks will worsen economic activities, slow down economic growth, economic activities, and obviously tip the global economy into a recession. I was talking about the oil and gas sector earlier, about our production, this oil situation and our external reserves. We are going through a misnomer as an oil producing country. Most countries are money to the banks. Russia, whose oil is being spunked by the Western countries at $810 billion. In fact, a country like Saudi Arabia, who is the swing producer, who can actually increase production by up to more 1 million, but it's not saying anything, it's just keeping quiet and accumulating reserves. Countries like Iran, Iraq, several other countries who are producing to their OPEC quota are just smiling to their banks, wishing that the war will continue. But unfortunately, a country like ours, which should actually be the largest crude oil producer in the world, in Africa, is actually suffering a decline in foreign reserve. We've seen a decline of more than $1.1 billion in our foreign reserve in the past 6 months. We saw our reserve close at $39.1 billion from a $40.51 billion recorded at the end of last year. So what does this tell us? This is a period when you are talking of elevated crude oil price. I mentioned that about 140 crude price has actually increased on average compared half year of 2021 to half year of 2022 by over 140%, from just about $58 per barrel to an average of about $120 per barrel, but $112 per barrel. But where are we in terms of production? You can see the impact on our reserve. Our reserve will continue to decline at a period when we should be celebrating and be talking of Russia-Ukraine windfall. This is a pictorial illustration of what has happened in crude prices and what has happened in our oil production. If you look at this, you will observe that Brent crude, which serves as the benchmark crude for Nigeria's Bonny Light, average 110 barrels, $110 per barrel in the first half of the year, and 118 barrels following Russia's invasion of Ukraine. Nigeria has consistently failed, I mentioned it repeatedly, to meet its OPEC quota. In May, oil production stood about 1.02 million barrels a day, according to OPEC data. A shortfall of about 715 million barrels per day. 15,000 barrels, not 750 million barrels, 715,000 barrels per day when compared to the OPEC quota of 1.736 million barrels per day for May. Nigeria's failure and that of Libya to meet the production quota are contributing to the supply shortages and surge in oil prices. Nigeria's quota for July is 1.799 million barrels a day. That's called 1.8 million barrels a day. And OPEC just last few days further increased our August quota to 1.826 million barrels per day. You just imagine if Nigeria was meeting this production quota. We would have been in a very comfortable economic situation. Today, we would have been having declining inflation rates, building up of reserves, strengthening of the local currency. But unfortunately, that's not the case. We are suffering double whammy because we're importing refined petroleum products at current elevated market global prices, whereas we're not able to export the crude product, which would have earned us the income to import those products. But ideally, if the economy had been well structured and well positioned, we should not just be exporting crude today, we should also be exporting refined petroleum products, which is what countries in our position are enjoying today. And assuming Nigeria is exporting 2 million barrels of crude, like we have done in the past under Biden government, about 2.2 million barrels of crude per day. And we were also exporting millions of barrels of liters of refined petroleum products. Just imagine how strong and how vibrant this economy could have been. Inflationary pressures. Of course, I had mentioned in the course of this conversation that inflation has gone to 17.71% in the month of May. What are the implications of this as it relates to our economy? We're seeing a drop in purchasing power. an average household is spending more to buy, spending larger quantity of naira to buy the same quantity of goods and services, or spending the same quantity of naira to buy a smaller fraction of what they used to afford. So which means you're going to see a decline in aggregate demand because your income can no longer afford the same quantity of goods and services it used to afford you. And that will lead ultimately to a reduction in productivity and employment, because if there's no demand for goods and services, the employers of labor will not employ. And we are seeing a desperation as a survivor. Many Nigerians are looking for shortcuts to make their ends meet. Some have resorted to prayers, some have resorted to unethical endeavors, some have resorted to short subscribing to mouth-watering, unrealistic offers of quick money, and they are worsening their situations. We're going to see an inventory pile-up due to slow demand, deterioration in standard of living, and increase in level of crime. Of course, criminal activities have become pervasive across the country because of economic hardship. Food inflation, which for me is the one that affects most households, because if you look at the basket of household consumptions, you realize that food accounts for more than 50% of average household consumption in the country. So food inflation is at a 9-month high of 19.5%. And I have used the basket that I said is actually subject to review. But even if you use that basket that was constructed in 2009, you realize that food inflation has moved year on year by 19.5%. Remember, the implication of this is that if you assume that the food inflation last year was about the same 19%, I think it was about the same time, it was about 20%. If you add the 20% to 19.5%, it simply means your purchasing power as it relates to importation of food has actually weakened by almost 40%. So the food item you used to buy for 100 naira, then you are now buying it for 140 naira. That's what happened on average. Because you need to emphasize, because there are some whose prices on a one-on-one basis have actually worsened beyond that level. Of course, we're seeing pressures. The pressures are coming in areas like wheat, derived products, cereals. Some of these items are imported, have wheat import component. Bread, for instance, we've seen an average price of loaf of bread move to about 800 naira, just a loaf. And we are seeing increase in the price of potato, tubers, wine, fish, meat, and all, what have you. Core inflation is also not relenting. Core inflation has moved to 14.9%. But the problem is not so much on core inflation, because our core inflation is partly suppressed. When I mean partly suppressed, because we're not paying the market price of fuel. If we had paid the market price of fuel, I'm sure the situation in Ghana would have been better than the situation in Nigeria today. Because government is still subsidizing petroleum fuel. So we're not, in as much that the price has actually moved up. I know outside Lagos, or even in Abuja and some other up-country locations, the price of fuel is as high as 180 naira, and in some locations like Kano, the price is between 200 and 210 naira. So, but that would just still do not represent what the price would have been if the landing was coming at market prices. If you take, for instance, another fuel source, which is a diesel or AGO, automated gas oil, which is very critical for the manufacturing sector and some high-end households. The price has moved from about 250 naira to about 850 naira per liter. And these costs like that are going to be passed on to the core inflation, because the manufacturing sectors, most businesses run on gas, fuel, self-generated energy sources, driven largely by diesel. So you're going to see the pressures in terms of core inflation is coming from the price increase in gas, liquid fuel I just talked about, the AGO, even your PMS or premium motor spirit, garment, solid fuel, cleaning, repair, and hiring of clothes. So these are major pressures where the pressures are coming from. And the question you ask is, are these pressures likely to abate in the next few months? That is quite unlikely, because one, the price of fuel today is going to worsen. I mean, even the PMS, because government is struggling to meet its obligations to suppliers. Two, the price of transporting the fuel because our pipelines are not working. It has also increased because of increase in the price of AGO or diesel. So, and the people who are into the distribution of fuel are factoring or building the cost of transporting. So we are seeing a increase in diesel price and increase in fuel pump prices, irrespective of the fact that government has tried to moderate by increasing the bridging cost by 10 naira. But that pressure is likely to worsen. Two, the issue of food inflation is also likely to worsen. We're still witnessing crisis as it relates to the major food production beds of the country, the Northwest, the North Central, and the Northeast, as a result of worsening impact of the herdsmen as well as the bandits added to the Boko Haram impact. And the Southeast is not helping matters because the unknown gunmen are still on our page in the Southeast. Southwest seems to be slightly the oasis, but unfortunately they're attacking our war, and some other few of such sporadic attack, opportunity attack, also putting fears in the minds and the hearts of citizens. MPR, the Monetary Policy Committee, increased rates in the month of May to 15 to 30%, an increase of 150 basis points, hoping, aping what other central banks have done. I had mentioned earlier that virtually all the central banks, about 40 central banks have actually increased rates. But the questions I've asked that, can we really fight the current inflationary pressure from increase by increasing the monetary policy rates? I think the answer is no. The simple reason, this is a supply-induced inflation because of shortfall in supply of energy sources, because of shortfall in supply of food items, prices have gone up. So it's basically a supply-demand equilibrium mismatch. And if you increase rates, the impact of rates that for countries that have proper transmission channels, like Western countries, where when rates are low, consumers borrow from the banks so as to increase their consumption. Where they have credit culture, people can actually consume ahead of their income. In such instances, by increasing rates, you slow down consumption. But can you slow down the kind of consumption of the kind of a product that we are talking of impacting on cost push inflation? Can you slow down the cost of consumption of energy sources? The answer is no, because you need those diesels, you need those fuels. Can you really slow down? Are you going to stop moving around? The answer is no. Two, can you slow down on the consumption of basic food items, wheat, cereals, corn? The answer is no. So if the answer is no, so the only way to fight this kind of current inflationary pressure is to work on alternative energy sources. And I think countries like Italy is trying to do that. They are going to countries like Algeria and trying to enter an agreement to explore and exploit more of Algerian gas. Unfortunately, Nigeria is not reacting to it. We have so much of gas supply, which today we should actually move aggressively to attract investment. We have the brass LNG that has been stalled, that has the capacity to increase multiple food and foreign exchange earnings, just the way LNG, Bonny LNG is doing. We have the Okoloko LNG in Ondo State that's also stalled, that the government, if we have a focused administration, should approach the IOCs, who are the major drivers of these projects, to put and get their foreign countries, parent countries or foreign owners, to put pressure on them to go back and make this investment. At this point in time, we should be attracting billions of dollars investment in the gas. That, for me, is the way to fight the current inflationary pressure and not necessarily increase in interest rates. But we're going to watch, the jury is still out. We're going to be watching and to see if the pressures are not going to have the unintended effect of shutting down the world economy and tipping the economy into a recession. That's my great concern about the parameter that global central banks have adopted. Of course, the IMF president, Christine Lagarde, said, look, fighting inflation has become an art instead of a science. What that means that they are just doing any tool to eat to see if we quench the fire. And my take is that those tools are misplaced and they are wrong tools. Back to what we're discussing. Nigeria's situation, because we are now basically focusing on Nigeria's situation. Nigeria's situation seems to be worsening because we have seen a further accumulation of debt in the country. We are currently seeing our national debt at about $100 billion. Local currency debt at about $40 billion. Foreign currency debt about $40 billion, and local currency debt at about $60 billion. Total debt is about 41 trillion naira today. And of course, we see local currency debt rose by as much as 22% within a 1 year period, 22% within a 1 year period. And we also know that the implication of that is our debt service obligation has increased. We're looking at a debt service of over 668 billion naira, call it 669 billion naira in the first quarter of this year, an increase of about 9% compared to what it was in the preceding year, in the preceding period of last year. So this, of course, we know that the government pays a paltry amount as interest on T-bills, and that's why, interestingly, there is a mismatch between inflation rate and interest rate in the country, because the federal government cannot afford to pay commercial rate or market reflecting rate on T-bills. If it does that, it's going to tip its interest payment obligation above 100% of government revenue. There are concerns by IMF that our debt service will be consuming more than 100% of our total revenue by 2026 if we continue in the current trajectory. Now let's look at what has happened in the domestic equities market. We've seen an increase in domestic equity prices or market index. As at the close of business yesterday, the market index had gone year to date to 21.3%. The main board of the index had gone up by as much as 30%. And then you have the NGS 30 at 9.6% and premium board index at 18.26%. But at the end of the first half of this year, we saw a market index of all-share index of 51,817 and a market capitalization of 27 trillion naira. I'm going to dwell so much a little bit on this, what is driving market index. Of course, we know that in the investment climate, in Nigeria's investment climate, the options of investment are highly restricted. We don't have the broadness as you have in some countries of the world. So what we have seen is that if you take, for instance, the options available to you, you either do fixed income, you do equities, or you do Eurobond if you have the capacity to convert to dollar, or you do real estate or other minor derivatives like mutual funds. So you don't have so much, and because our currency is not convertible, you really can't go to Ghana where interest rates is about 26%, to go and invest in Ghanaian local currency instruments at 26% because you really can't convert to dollar or convert to cedi. So you are stuck with investing within the local market. So that what has happened is that local portfolio investors have no choice in the face of low yield and fixed income instruments. Remember that federal government T-bills, 364-day bills, which should actually be the risk-free, mirror the risk-free return, and should at the minimum be at the same level with inflation rate, is currently trading about 6.07%. And that's even an improvement from about 4.5, 4.6% it was before the increase in MPR. So if you just oppose that against the possible return you get from dividend income, it takes, for instance, a First Bank, which was not even considered as quite aggressive. The dividend yield is more than 7%. So most investors have actually decided to underweight their portfolios in fixed income and overweight them in equities. And that's why you've seen rallies in Nigeria's equity, contrary to what has happened elsewhere in the world. Most other global exchanges are in the red in the first half of the year. What are those sectors that you have to look at? Let's start from the banking sector. This sector used to be the dominant sector in NGX. But interestingly, other sectors have come to display. The telecommunication sector has come to elbow it away from being the dominant sector. The market sector actually was one of the laggards in the first half of the year, depreciated by about 2%. What are those factors do we think that would drive market activities? We've seen a hike in NPL, and what that means is that the banks are repricing their risk assets. Some of them are offering their customers 200 basis point increase in lending rates. And I've always emphasized it's the small time price takers that are going to absorb this cost. They won't be able to increase rate as it relates to the big ticket premium borrowers. But the subprime borrowers are the ones who will suffer the increase in rates. But give and take, we should expect, and the banks are also stalling or resisting any increase in deposit rates. Savings rate has remained low at where it was. Even deposit rates, in fact, unfortunately, that depositors do not have strong bargaining power. They don't have market powers to negotiate rates. So the banks are keeping their cost of funds static while they're increasing lending rates, even if they only succeed in doing that to the marginal or small borrowers. Because of the multiplicity of their number, they're going to see an improvement in their net interest income in the second half of this year. But they have to contend with higher costs of doing business, higher cost of operation because of increase in diesel costs. But given the banks are expected to benefit from the increase in the monetary policy rates, then we should expect increased spending in the second half of this year as a result of political activities. I've always said this, that this period you're going to see a number of hirings or new people who will join, who move away from being fully unemployed to being underemployed because they become political hirings that go attend, that are hired to attend party campaigns. And when they come back from campaign activities, they get some stipend, and they're going to spend this stipend in basic food items. But what basically happened, we're going to see an increased velocity in money circulation. And the banks, because most banks are now riding on alternative service delivery channels, they're not going to increase their cost in providing services to those who will need some level of banking services, but they are going to get the benefit of commissions and fees. Some banks are really shifting away from fund-based income to commission-based income. So the banks are going to get the benefit of increased money circulation, and increased velocity. Then the telecommunication sector. This sector, I expect, will also be one of the greatest beneficiaries, whether of the election period or even outside the election period. We saw a sharp increase in data income of MTN. There was a growth, I think about 14% of voice income, but over 100% increase in data income for, I think 86% increase in data income for MTN. And that trend is likely going to continue. In this particular period, we are seeing a lot of people migrate from voice-based usage of telecommunications to database usage of telecommunications. People are now using WhatsApp calls, which is data-based. People are permanently tweeting. Some people are permanently on social media platforms, Instagram, WhatsApp, Twitter, Facebook, and all what have you. So TikTok and what have you. So what the implications, you are using so much of data, and these companies are going to benefit from that. So they're going to see continuous increase in their data income. And two of them, MTN and Airtel, have gotten their payment service banks, banking license, and they are really now to possibly compete with the banks as it relates to rendering banking services. And remember that MTN has also gotten a 5G with another company that has also been licensed. MTN is likely going to be in a better position to roll out a 5G network quicker. And that means because of the heightened velocity or the heightened speed of 5G, people are going to feel so more comfortable doing video calls and then consuming a lot of data. And these companies are good investment opportunities. So our recommendation in that sector is MTN, Nigeria, and Airtel, Africa. I didn't mention our recommendation in the banking sector is Zenith, GT Bank, Access Bank, and Eco Bank Transnational. Then, as it did the industrial sector, we expect construction activities to continue. A lot of government are going to do the last push to increase their acceptability to voters particularly governors who are running again or governors who are anointed their successors, and the need to show dividends of democracy. So we'll see a lot more construction activity. Again, the industrials, so we should expect the demand for cement to continue, given the paucity of infrastructure supply in the country. Our recommendation in this area are Bua Cement and Lafarge. Then on the oil and gas sector, we've seen this sector as the sector that has enjoyed the highest increase in terms of market index. We saw a 58% increase in the sector, market index of that sector. And we know that the only upstream operator there, Seplat, is a major beneficiary of an increase in the price of crude. And it is not like that the war seems to be going to be a long war, given that Russia has changed its strategy in the war. Instead of an aggressive effort to overrun Ukraine, he had decided to adopt a flank and gradual takeover of Ukrainian cities. So that means the war is going to be a long war. And in that situation, we expect oil prices to remain elevated, as even Western countries are trying to wean themselves of Russian oil. So a Seplat is no brainer. That is our recommendation in that sector. Consumer goods. I had mentioned that we're going to see a lot of hirings when it comes to political activities. People who will basically be hired to appear in the at the campaign grounds to show that the candidate has a lot of followership. And these people are going to get some reward on a daily basis as they move from one campaign ground to another. And they will, because they don't have so much of income, their demand is still basically basic basic food items. So I expect that you're going to see demand for basic consumer items, beverages, for instance, beer, soft drinks. You're going to see a huge demand for that. Confectionaries, beverages like milk and other food drinks. You're going to see continuous demand for them. So I think operators in that sector are going to get the benefit of increase in the demand for their products. And our recommendations in that sector are Nestle, Dangote Sugar, Okomo Oil, and Cabre. Fixed income. We've seen, I had mentioned some countries that are already on the verge or are considered as teetering on the verge of default. I don't think many of these countries will default. I personally don't think they will default. Part of the problem they're having is they've been suffering the effects of falling in portfolio investors, shying away from investing in local currency, in frontier markets, investing in frontier markets. So it wouldn't stop them from meeting their obligations as it relates to their Eurobond commitments. So I think for us, this instrument remains a good class if you have access to dollar to buy them. Of course, you know, the Nigerian government issued a 7-year Eurobond in March, which was oversubscribed, and that led to a reduction in the yield on the coupon from a projected 8.75% to 8.37%. Nigerian government was supposed to come back and raise another 2 billion, but because our bonds are now trading above 10%, the government feels it's expensive and the market is not favorable to come to the market to come at this one, and the federal government has shaved that. In the secondary market, buying these bonds at this yield range makes a lot of economic sense. So if you have the wherewithal, accumulate frontier market bonds, particularly those countries that have oil exports, they should be able to meet, to weather this, the challenges of face. We've seen what I mentioned earlier, because of limitations in investment options, fund managers are still patronizing fixed income instrument, local currency fixed income instrument, because they don't really have alternative. Your currency is not convertible. You can't go and invest elsewhere by converting your currency, your naira to a foreign currency. So even as 10-year bonds are trading about 8%, there is still demand for such instrument by portfolio investors, particularly the pension fund administrators who have caps in terms of asset classes and the volumes they can put in one particular asset class. So the federal government bonds will continue to enjoy patronage. We saw its Sukuk bond, federal savings bond is on offer today, and previous offers we are fully subscribed. So we think this trend will continue, even though the yield on fixed income instruments are far below the cost of money. When it comes to cost of money, the inflation rate. What are the macroeconomic outlook for the country? We expect revenues will continue to underperform with weakened oil revenue, with lower crude oil production. We expect that inflationary rate pressure will continue. Energy sources are going to continue to remain high, and then food prices are going to remain high. So inflationary pressure will continue. Our foreign reserve will still continue to be under pressure. Unfortunately, we are not able to meet our crude oil production, and we're not attracting foreign portfolio investments. Crude oil production will continue to hurt us. The rate at which oil pipelines are being breached, there doesn't seem to be any end in sight. And like I said, our FX pressure will continue and possibly worsen. There are projections that Naira could extend its losses, even though it's currently trading about 450 Naira to $1. High and unstable inflation rates, depreciating foreign exchange rates are bane to the corporate performance. Of course, what this means that your cost of production is continuing to increase, and if you throw into this mix the high rate of energy supply sources, you can imagine what businesses are going through. The present interest rate will continue in the current period. I had mentioned earlier the federal government cannot afford to mark a rate on T-bills to market to be reflective of inflation rate, because it cannot afford to meet service obligations on those debts if they are priced at rates that are reflective of inflation rate. We're going to see pressures on corporate earnings come from two sides, the top line and the bottom line. The top line in terms of revenue, because of weakening purchasing power, which will lead to a reduction in demand. Unfortunately, the cost of doing business also going up. So the business leaders are going to have pressures from both ends. And then political uncertainties will mean that foreign portfolio investors will remain on the sideline to watch as events unfold and watch whether Nigerians can make the right decision for the first time and call in a person who has the capacity to do the job. Fixed income, I've talked about this, despite the elevated yield, elevated inflationary pressures, the government cannot afford to increase rates. Unfortunately, the continuous borrowing by federal government by ways and means is also exerting a lot of liquidity pressure into the economy. I also spoke extensively about this, that we expect Naira to further depreciate in the coming months as a result of major supply constraint. The central bank, when we talk about central bank not supplying FX, they don't have the war chest to supply FX, because the FX the central bank has coming from export of crude, and export of crude have actually weakened. And if you even look at disaggregate the current export of crude, you find out that most of the export is going from deep offshore, where Nigeria's fiscal benefit is minimal, where the production sharing arrangement is very weak. So the portion that the government is getting a lot of income is actually minimal. Alternative investment outlets. This is a time when you need to be very sagacity in terms of broadening your investment horizon. This is a time when you need to consult the likes of Cowley to guide you in making your investment. It's a time when you need to look at alternative asset classes. One of those alternative asset classes is real estate. Real estate, I did a study last weekend, and I realized that the real estate value, even in a place like Abuja, has continued to outperform depreciation of local currency and inflation. So real estate investment asset classes are a wonderful investment to hedge against current market environment. You also need to look at the likes of mutual funds, particularly dollar-denominated mutual funds. You have to look at the likes of Eurobonds if you have the financial muscle to do Eurobond. And you also need to avoid going long. It's a time when you have the kind of yield environment, you stay in the short end of the market. And there are equities. We have also highlighted that dividend yield are likely going to outperform return on fixed income instruments, and there are prospects of capital appreciation. Diversification of portfolio, you can't go wrong with that. You need to show caution in your investment. It's not the time to be very aggressive. It's time to be you have to be very deliberative in making your investment choices. Timing is of essence. Know when to go into the market. You need to stay liquid. Cash is king at periods like this when opportunities can actually come up at the break of the day, and you need to take them quickly. On that note, I want to thank you for listening. These are our contacts. You can reach us anytime, and thank you all. I can take questions.
Thank you very much, sir, for the insightful presentation. We've really seen extensive review of the happenings across the economy and also the financial markets, and also the views on the possible happenings across in the economy as well. So we have questions from a lot of questions from participants. I see very interesting ones. So I'll pick the ones that I'll go to. So there's particular question about inflation. We have about 3 questions that I think can be answered, and they are particular to inflation. So the first one is asking for the outlook of the inflation rate at the end of the year, what we think the year will close at, the full year 2022. And then there's also a question also asking for strategies to also, I believe, to defend or to hedge against the loss in purchasing power of due to inflation of the on the income strategy. So strategies to so strategies to defend income against depletion of purchasing power. So based on those are the questions on inflation. I don't know if you take those ones, sir. Then I'll take the remaining as well.
Okay. The prediction on inflation rates, it will be difficult for anybody to predict accurately. But what I know is that all the indicators, there's heightened downside risk of inflation in the coming months. I had taken time to discuss some of those factors that will likely lead to further deterioration in inflation. The energy cost is going to increase. Even the pump price of fuel is going to increase because it's actually not economical to anybody who is in the oil and gas sector to sell fuel to you at the filling station at 165 naira because of the trucking cost or the bridging cost. 2, I'm talking of, and then the government is struggling to meet the import fuel importation bill. And then the fact that diesel is deregulated, it has to be passed on. The burden is also passing on, transmitting through the fuel price. That's that. And then in terms of food inflation, that will also worsen in the coming months because we are seeing basic input material for food items like wheat, corn, sunflower oil, all prices are increasing. And at local level, we're also witnessing displacement of farmers, which is constraining food production locally. So inflation will likely going to continue in the short term until production catches up with demand. And I said earlier that the kind of inflation we're witnessing today needs to be fought with production, not with cut down on credit. Because in the case of Nigeria, we don't even have consumer credit, and therefore credit is not a good transmission channel for cutting the inflation in the country. As it relates mitigating measures one can do, I had mentioned that investment in real estate has seemed to have actually outperformed inflationary pressure in previous years in Nigeria's history. So real estate is good. And mentioned Eurobond, at least you mitigate against depreciation of local currency when you invest in Eurobond. Even if you don't have the wherewithal to do a single ticket Eurobond on your own, you can invest through a mutual fund instrument that are dollar denominated. Then the other things you have to do is also front load your consumption. If there are some consumption that you know are inevitable and you can borrow Naira to consume them today, do, because by the time you are paying back the Naira, your cost would have been frozen by that fact that you already acquired those assets or those items. So from loading your consumption when you have the wherewithal is also important at periods like this, so that you don't suffer depreciation of your savings if you are saving in Naira. So I think those are some of the basic plain vanilla run-of-the-mill measures you can take. Other measures that are a bit complex, I think you need to consult your financial advisors like Kauri, which have already highlighted our contacts.
Okay, thank you, sir, for the answers. I'll be taking some other questions. There's one question from Haruna Khalifa, and then there's another one from Miracle. These are asking about the subsidy regime. So the questions are what do you think of the extension of the subsidy regime by the federal government? I think that has to do with the extension of the 4 trillion. And then the other one is trying to know the best product amongst the one that we consume, that is from PMS, DPK, and cooking gas and AGO. Which of them do you think the government should be subsidizing? I think this is a drop off from how we've seen the energy prices due to the surge in diesel prices affect the price of standard of living in the economy, and also prices surge. So these are the ones from subsidy regime. And also there's one more question that just came in. It's from an anonymous one. This one is also asking about your take on the subsidy regime. How do you think that it is sustainable for the country to continue like this, considering that we have not taken advantage of the increase in oil prices as well?
Okay, Mohammed, let me take the issue of subsidy regime. Unfortunately, we should have removed subsidy earlier, but we didn't do that. And this is the most inauspicious time to tamper with it. What the government can do is to have some level of price modulation, which means allow some level of adjustment in the price to accommodate the inevitable increases in cost. And when I talk of inevitable increases in cost, I talked about the trucking cost, or what they call the bridging cost. If you take, there's no depot that is working up country. Even Mosimi here is not working, which is not too far from Lagos. Because if you put products in those pipelines, they are immediately broken and then they are stolen. So all distribution are going through trucks, tankers, and these tankers are fueled by diesel. So when the tanker drivers buy this diesel to truck the products, they have to factor in that cost when they get to the stations. So these are these are constraints to the extent that the government can keep a tab or what is 5 naira to a liter. So what the government can do is allow some level of adjustment, flexibility in the pricing of PMS. As it stands today, the option of which one should be subsidized no longer arises, because we've taken out the subsidy on DPK, which is fuel, kerosene. We've taken out the subsidy on AGO, which is diesel. We've taken out the subsidy on LPG and the other cooking gas. So if you try to introduce them in the first place, the government doesn't even have the revenue profile to subsidize anything. I don't know whether you saw that the subsidy for in the month of May was 800 and something billion naira. And the allocation, the federation allocation is about 600 and something billion naira, which means the subsidy loan that the government had to pay is higher than the amount that's available to allocate. So the NNP will deduct another 1 something billion naira from this month's allocation to offset what they couldn't deduct. That will just show you how bad our situation is. The fact is this, our structural problems are fundamental, and the earlier we start fixing them, the better. we need to, one, address the issue of stealing of pipelines. We need to look at what are those factors that are making it impossible to control the rate at which products are, crude product is stolen. And then reach out to those communities and address those factors so that crude production will go back to about 2 million barrels. If we are producing 2 million barrels, we won't be in the current situation we found ourselves. That's the first stage. Then eventually oil price is going to moderate. At that point, you need to take out the subsidy so allow refineries to come up. If they are refineries, local refineries, we wouldn't be in the same situation we have found ourselves today. And the telecommunication sector is one sector that has proven that when you hand over assets, operating activities, business operations to the private sector, and that is done in a very orderly manner, the private sector will eventually lead, competition will eventually lead to a reduction in cost. We used to buy SIM card for 20,000 naira, when 20,000 naira was much higher, more valuable than what it is today. But today, a SIM card is just about 500 naira. And semester is 300 naira. That's the benefit of private sector efficiency when it comes into an industry. So we are already in a difficult situation that you just have to, we just have to muddle through because we have not created those opportunities that would have allowed us a stronger response at this point in time.
Thank you very much for those insightful answers also. So now going into, we have some questions also from Helen, also from Sydney, and Cherish. So these questions are to going through the same line. They're asking about the financial markets, which is the bonds market, to be specific. What if it is safe for, if Nigeria can continue to service her debt, and if it is safe for long-term bondholders. So I think you've also answered that question in an attempt to answer the first question that you said. So I'll move on to the next ones. So we have about 3 questions relating to our monetary policy MPC meeting that was held. So the question is, if the increase in the MPR, how effective is it in tackling the rising inflation?
Okay, I think I've also answered that. And I said like,
yeah,
the central bank adopting tools that are not going to work because the pressure on inflation is coming from supply bottlenecks. And you need to address that supply bottleneck by increasing those items that are being supplied. And the items whose supplies are in short demand, in short supply, are critical items. They are what we call necessities. Their demand is largely inelastic. So you can't cut down on demand by increasing, constraining liquidity or credit, because these are inevitable things. You can, in Europe, you can't go out without light. Neither can you survive without energy supply anywhere in the world. So the problem is that the central banks are using the wrong tools, because the problem is not a central bank issue, is a fiscal issue, and the fiscal authority have to step in and take the necessary measures to improve on supply of those items. Which is why, like I said, Christine Lagarde, the IMF president, said, look, fighting inflation has become an art. And for the president of IMF to say that, and you know what art is? Art simply means there's no logic behind it. When you say something is an art, there's no logic behind it. But in science, there's a logic, which is cause and effect. If you say 2 + 2, it must be equal to 4. You say that 2 molecules of hydrogen and 1 molecule of oxygen will give you water. If you go and mix it in China, it will give you water. If you bring it to Abuja, it will give you water. That's science. So when it becomes that it can either be 2 molecules of hydrogen and 2 molecules or 4 molecules of oxygen will give you water, then it becomes an art. Anyway you mix it. You're just trying to solve a problem any way it comes. So, and that's where we've gotten to when it comes to the way the central banks are fighting inflation.
Okay, so we have this question. This is from Tajuddin Olainka. It says thank you, Mr. Johnson Chuku, for a well-researched paper. saying is also pointing to the fact that central banks around the world are raising rates to fight the current surge in inflation, while some less developed economies around the world, including Nigeria, might not be so favored in arresting supply side inflation using interest rates. The developed economies of Europe and America might have taken the right position raising interest rates to address the supply side shock. So I think largely I think this question is just also pointing to what you just answered, which is the divergence in the monetary and fiscal policies of that we have currently, just like you just mentioned right now. So
Okay, just to add to that, so that it won't be like Nigeria cannot respond endogenously. Endogenously means within using our own internal tools. If we cut down or slow down on the rate of insecurity in the country, or if you can reduce the rate of insecurity in the country, and people who are in IDP can go back to their farms and produce food, you're going to see an increase in food supply. And there will be what they call food substitution or consumer substitution, where people are going to move largely away from bread and other wheat products to home-based or homegrown food items for their breakfast tables. You're going to see people eat potato, fried plantain, boiled egg, fried egg in the morning instead of looking for bread. And that will cut down on the demand for this. So we are going to slow down on even food inflation in the country. But it has to be, unfortunately, to fight the insecurity in the north is not going to be a light bulb effect. They're not going to just put on the bulb and then you see brightened room. It's going to be a gradual process, and I don't think we are doing anything that one can point. I had mentioned the worsening situation where a presidential advanced motorcade was attacked by bandits. It doesn't happen anyway. If it happens, it's considered to be an attempted coup. But I have not seen the response, forceful response by the government. You killed 34 soldiers, it doesn't happen anywhere in the world. Before you kill 34 soldiers in a war situation, it's a bad war. But nobody has responded. And how do you think civilians in Niger State will feel, or in Shirodo will feel, if soldiers are being slaughtered in that way? Can anybody go to farm in that place? So that's the problem is, if we can address the issue of insecurity, we're going to improve on food production and we'll slow down inflation. Because the key thing to fight the current inflation is you need to increase supply. You just need to increase supply to meet demand.
So I think I'll be taking, due to time constraints, I'll be taking the final question right now. Okay, so I think this is from Helen Okoro. She's asking, the projection of the equities market. We've already spoken about that. Then the last one from Faith is, how can one diversify one's investment portfolio? Also, how can a young investor and new entrant build a sustainable and rewarding portfolio? I think also that has been asked. We have to fall back to your financial advisor, which carries in the capacity to do that. So I would like to thank everyone for taking your precious time to join us for this webinar. I hope it has been insightful and interesting for you as much as it has been for me. It's been interactive, and this is the second edition of the webinar that we'll be having, or will subsequently be having one. So I would like to hand over. Okay, we will also share the slides after the presentation, and it will be available to download. I'll also like to welcome on our Senior Vice President, Mr. Okudili Ogu. He's also a veteran in this field, finance, expertise, knowledge in finance and investment field, to give us the vote of thanks for this session. Over to you, sir.
Thank you, everyone. Unfortunately, my video cannot be enabled because the host, it can be enabled now. Thank you, everyone, for finding time in your very busy schedule to join us in this webinar. In Carry Asset, we are promising all our stakeholders that will promote knowledge-based investment practice. And that we have started by ensuring that this webinar series goes on every quarter. Now, in case you are wondering who we are, Carry Asset is a boutique investment bank licensed by SEC to provide funds and portfolio management services, broker-dealer services, and issuing house services. So we are well equipped to provide and address all your financial issues and address them effectively within the Nigerian capital market and within and as a regulated entity in Nigeria. So once again, want to thank our MD, our group MD, Mr. Johnson Chukwu, is always doing what he knows best to do and delivering knowledge to everybody. I also want to thank Hamza Mohammed, who coordinated his activity and his team. I want to thank everybody for having time to be with us. Thank you and God bless.
Okay, so thank you once again, thank you so much for your time. I know, so that will bring us to the end of the second edition of our webinar series. Watch out for the third one, as we'll also be taking a reflective view of the happenings over the third quarter. Thank you very much for your time.